Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. In the process of heading lower from the break below the late June, late July ascending triangle, the one highlighted in dark blue on my daily chart, in this process of heading lower, the market created a late July to late August bearish shift pitchfork, which you can see highlighted in purple on my daily chart. This pitchfork had been brilliant at showing the bearish angle of attack of this market from late August until 3 weeks ago, when the market broke up over the upper time. The reason I say broke rather than breached was that 3 weeks ago we had a weekly key reversal up here, and if you're going to break such a pattern as a bearish shift pitchfork, then there is no better tool than a weekly key reversal up, apart from perhaps a monthly key reversal up. Anyway, 2 weeks ago the market approached its first real test overhead, and that was and is the declining short medium moving average, currently at 1332, highlighted in green on my daily chart. This is not that heavy a resistance, though it did do a good job of capping the market back in late August, then 2 weeks ago, and now again this past Monday and also today. At the same time, the short moving average, currently at 1310, has started to provide some support, though I personally am not that certain this support is that extensive as one would like. Thus, it is worth noting that though prices are knocking on the door to try higher, more forceful resistances lie overhead, notably the recent 50% Fibonacci line at 1349 and the slowly declining long moving average, currently 1399. And this is even before mentioning the overhead band of congestion between 1378 to 1409, a band I had spoken about in earlier times, as back then it had contained the base of the earlier late 2022 descending triangle at 1378 and the lesser Fibonacci line at 1409, both exceptional levels in the past. For the moment, the market hasn't made up its mind whether to head higher or lower, but I would point out that perhaps time is not on its side. As though the short medium moving average has stopped declining, it is still nevertheless just above the market and seemingly susceptible to bullish attacks. Chicago soybean meal. In the process of moving lower from the break in August, below the mid-June to early August ascending triangle, which is highlighted in bright red on my daily chart, the market formed another pattern, a late July to late August bearish shift pitchfork, which you can see highlighted in purple on my daily chart. This pitchfork gave a brilliant indication of the bearish angle attack from late August until 3 weeks ago. Now, there was no weekly key reversal up here 3 weeks ago, as we saw back in soybeans. But that did not mean it was not immune from the effects of what happened in soybeans. No. We saw this play out when prices punched up through the upper time of the bearish shift pitchfork. The market continued to move higher, overcoming the first 3 overhead resistances of the declining short medium moving average, currently at 398.5, and the combination of the medium moving average, currently at 406.10, plus the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60. These all became supports. Last week we saw a strong move higher, up through the lesser Fibonacci line at 415.5, and towards the combination overhead of the lesser Fibonacci line at 425.90 and the more important declining long moving average, currently 426. Highlighted in gold on my daily chart. As I said 2 weeks ago, and I quote, we really start hitting some serious resistance up around the lesser Fibonacci line at 425.90, because it would seem that if prices were to get that high, then the addition by then of the declining long moving average would reinforce what would seem some pretty light resistance. End of quote. Well, that is just about what has happened. As prices rose to test the declining long moving average the whole of last week and the start of this week, the overhead resistance was pierced, but so far we have not seen any closes above it. Most of this past week has seen the market drop back down to the lesser Fibonacci line at 415.5, just as it's doing it today, and seemingly establish a congestion between the lesser Fibonacci line at 15.5 and just above the 410 area. Further down, the medium moving average is now separating away from the 50% Fibonacci line at 40360, and thus it would seem that the support area may be weakening, as a combination of them both was always stronger than each of them individually. All this action over the last few weeks set up the opportunity for October to be a possible monthly key reversal, and thus it has turned out to be a monthly key reversal up. The question now is whether this further bullish factor, admittedly a lagging one, whether it would stimulate some further bullish incentives, more than what we have already seen. The question is still open, but look out in case the market chooses to establish a trading range between the medium moving average below and the long moving average above. Finally, this brings me once again to a point which I raised 22 weeks ago, and which I will keep raising for the rest of this year at the very least. You see, on my longer term monthly charts, with 10 months of the year gone and into the 11th, 2023 is set up to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve either above 471 even or under 399.10, then we'd be on. Anything in between and would have a lesser outside year. Right now we are looking at an annual outside year, but we still have so much time still to go. Chicago soybean oil. The recent key pattern here had been the late June to mid-August head and shoulders top, which had an extension, or handle if you like, to it. The primary target for this pattern was in the 60.38 zone, which was achieved in early September, and a secondary hard reach target down in the 56.74 zone, achieved in late September. In the process of heading lower from this head and shoulders top, the market initially made a descending wedge pattern, which, over time, has become a bear channel, and which you can see highlighted in blue on my daily chart. This market, much as soybean meal, was not immune to the weekly key reversal up made in soybeans itself, and tried to turn a test lower early 3 weeks ago into a break up over the upper trend line of the descending wedge pattern. But here it was not successful, or rather its only success was to turn the descending wedge pattern into a bear channel, currently 47.46 to 51.39. Immediate overhead resistance is now from the combination of the upper bear channel and the March 2013 high at 51.26, whilst immediate support is from the 38.2% Fibonacci line of the March 2020 to April 22 move at 48.95, which doesn't look that strong, and we may not have that much support below that until the lower bear channel line. Finally, and this refers to an earlier statement I made about the larger descending wedge pattern seen at the start of this year, where I said the following some 18 weeks ago, and I have since also done on every opportunity, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." I will not expand on this idea any further at this time, as it's still early on, but the recent market decline fits in with this idea, though the expectation would be to eventually witness a fall down to the area of the May and June lows between 48 and 46 even, which is possible and indeed easier to see now than in previous weeks. That is why I do wish you, and also me, to keep this in mind, this idea in mind, especially following such recent actions seen here and elsewhere. It all might well fit into such a pattern idea. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.